Welcome everybody. We're very excited today to bring you a great panel on how it's called Dollars for Development Pro Tips. And this all has to do with building budgets, particularly considering this grant season is started. Many of you who are listening to this are maybe thinking of applying to an STTR or an SBIR award, and you are getting ready to put some budgets together. So this is the perfect session for you. We're gonna have a great set of speakers from Grant Engine. CEO Sam Tetlow is here. I'll let him introduce the rest of the team. We work very closely with Sam with Grant Engine for several years. He works with several of our startup companies as CEO and other roles. So we work very closely with him in different ways. And again, he has lots of experience both from the company perspective as well as with Grant Engine in his role as CEO, managing all the grants and supporting grant writing services as well. We're gonna have also some speaker for today, Judy Prasad, which is our own KickStart representative here. She is our operations and program manager who started in April. And she has a lot of experience herself, was a scientist. Her background is in life sciences. She's a neuroscience major in her undergrad, and then later in her PhD and postdoc work from McGill University, and then from UNC-Chicago, where she also worked with a company, a startup company called Abinovan as well, in development and operations. So that experience has really helped her understand both from the side of working as a scientist, as well as working with a startup company and what it takes to apply for STTR and SBIR grants. And now in her role as operations and program manager, she also knows what the universities are looking for. So it's one, considering what you as a startup company are going to do when you're writing these grants, but she's also going to touch on some points as to what it is to structure this awards, not just to get the funding, but from the university perspective, what to consider, some pointers and tips as well. So without further ado, Sam, please go ahead and also introduce the rest of the fantastic Grant Engine team.
Yeah, thank you so much, Mira. Appreciate the opportunity to be here with everyone this afternoon. And can you hear the audio and video? Is that synchronized well enough? Okay, great. So really pleased to introduce certain members of the team. Let me jump to that real quick. So I'm the founder CEO at Grant Engine. We have been in business for about 4 years and really started Grant Engine based on a need in the marketplace for a better, different way to help companies build great products. And we do that in a pretty defined way that we'll talk about. Very happy that Lenika Starks is here with us. She is extraordinary in her skill and grace with how she works with clients. Was at Duke University for a number of years and is full-time here as part of the management team that you see on the bottom line of this slide. And she'll be helping us have this conversation this morning. Lenika, anything else you'd like to say?
No, I think you covered it. Thank you.
Okay, great. For those of you that have worked with Lenika, you know her to be a wealth of knowledge and insight. So that's a phenomenal resource that we make available to our clients. Also joining us is Dr. Susanna Harris. Susanna is a newly minted PhD from Carolina. So we're happy to have her as part of this family at Grant Engine, as part of the wider family that we think about for UNC. She also started and leads a nonprofit called PhD Balance, which is a very important initiative around supporting PhDs as they go through that supernatural process. So Susanna, anything else you'd like to mention?
No, I'm very excited for this. There's always new stuff to learn in this different space. And so I think I'll speak for myself. I think I will be learning a lot on this webinar, as will everyone listening.
Great. Well, let's dive into an agenda first. And I just want to start by saying that the Grant Engine team and also the UNC team have put in an incredible level of effort. So I want to thank Judy, you, Hallie, you, and Mira for your support of just this effort to bring forward this kind of knowledge. And a special shout out to Lanika and Susanna for the incredible energy and focus that they've put into this content. It's my sincere hope that everyone on the webinar and really hearing it afterwards will benefit from this insight and also tell everyone else about what you've learned and where to go for resources. So we're going to do a quick overview of Grant Engine, get into the meat of the webinar around pro tips of how to get dollars for your development, walk through a budget example. Judy's going to walk us through considerations at Chapel Hill, and then we're going to do pre-asked questions and then any live questions. So if that sounds good to everybody, I'm going to dive in, and I'm going to go pretty quick. So if you have questions on the chat, holler away. So Grant Engine, we're really here to save lives. Like that is number one, number two, and number three on all of our job descriptions, and also extend the length of a quality life. This is our mission. It's how we think about working with companies. And that translates into what I think about as like a three-part harmony of how we win grants. And that three-part harmony is, number one, understand the current standard of care or state-of-the-art for a product space. Number two, understand how this innovative product or solution that you have will improve upon that current standard of care in a differentiated way, really to help the patient in a better way. And then lastly, what's the data that backs up that differentiated position? And there's a lot of detail therein, but that process of how we go through this work with you and how we articulate that differentiation is something we've learned over building tens and tens of companies that it works. Grant Engine has 68 people. Many of those are external reviewers that sit on study section where the conflicts clear. And that synthesizes down to about 23 individuals, I think all of whom have some graduate work, and most of us have PhDs and a few MBAs sprinkled in there as well. So our process gets a 2 to 4x win rate. We're aiming to get that better, but it's a good start. We really focus on US federal funding sources. So we do a lot of work at NIH, a lot of work at DoD, but really across the board, BARDA more and more, as you know, but FDA, DARPA, CARB-X for non-COVID infectious disease. There's a lot there. So we do focus on any US federal funding sources. And this is really just a quick overview to show the respective longitudinal funding opportunities. And I think everyone's likely familiar with phase 1 and 2 of the SBIR STTR program. But I want to make clear as well that there's runway in the future. Phase 2B programs are only $4 million in funding. Most of the institutes require a match, not all of them. So you need to go raise that additional equity or strategic partnership. So there's more than just $2 million here per grant. There's much more in the future. We'll go through a lot of these particulars as we go. We also have a accounting and compliance division that helps keep everybody out of hot water. And then this slide, as you heard earlier, differentiation matters. We track our win rates compared to the national average. These stats you see here are since inception at Grant Engine. So we've been getting better over the years. So trend line is up on the blue bar, which is our win rate for each respective type of grant submission. The gray bar is the average win rate for across the NIH across the corresponding same time period. So that is also, we'll call that a good start, but this is the 2 to 4x better. And then this chart shows one half of the story of a longitudinal experiment that we did with a large public university in North Carolina. And this, the left to right shows the rolling cumulative win rates for when Grant Engine has been involved strategically. We're either co-writing or we are doing external review. So this figure over here really shows the cumulative win rate of all the wins divided by all the submissions. And the rest of this chart on the bottom line, which you don't see, compares it to when Grant Engine is not involved and we're just doing the submission. So a designed experiment where we added value, if you will, from a content perspective on the blue. And there's another line below that I don't want to show for reasons of respect and dignity that's not as high. And the difference is not something you'd need biostatistics to understand. So we think of this as success in a very humble way. We know that we have to keep earning that work every grant, every cycle. So we're keen to do that. Okay, enough of the commercial. Let's dive into the content that you've been waiting for. So I'm going to hit these slides in order, and as questions come up, we can go back towards them at the end. So one thing we've seen is that fixed and administrative, this is also referred to as overhead or indirect costs. It sometimes isn't obvious how necessary that is to folks that have not lived this dream in a company environment. And if you remember walking into your building and walking into the lab and having the insurance coverage for yourself, F&A is real. You do not want to minimize that. You're going to need it for CEO salaries, insurance, rent, legal bills, et cetera. So it's really quite necessary. Don't scrimp and reduce that to give yourself more dollars for R&D. It takes much more than direct expense to build a company. So we'll talk about statutory limits of the budget levels. Those are set and fixed. And of course, there are budget waiver topics. The links that you see there get you to a blog post at Grant Engine that list for you which topics are eligible for budget waiver, and we'll talk about those in more detail. Those are important to go after. It'll get you much more money, so that's a good thing. The premise of this bullet is simply that when you write your research strategy, you want it to be comprehensive and cogent in the holistic sense about all of the key activities that will advance your product. And then the budget wants to request funding for those things that are only allowable and does not have to be the maximum cost that the total effort would incur in the aims. And often, because of limits of what can go outside the small business, you hit a cap above which you cannot go. And that's okay. You want to max out your budget. But this point is just that your research strategy wants to talk about all the essential work that shall be done, and your budget wants to be maxed out. And if you articulate that the balance of the cost that the NIH budget will not cover will be paid through company funds or investors or partners, that is how you want to structure the budget versus the aims. The research strategy wants to show all the way through and through. The budget may not make it all the way there, and that's fully appropriate. Okay, where are you going to get all this extra money that the NIH isn't going to pay for? There's a number of sources, using your own money, angels, friends and families, venture capital, and then call it strategics. So pharmaceutical companies, med tech companies that invest either equity or co-development dollars into your company to propel forward the product development. Among all of those sources, a strategic co-development deal is among the most useful. It's always nice to get $10 million from a brand name venture investor, for sure. That's 2 thumbs up. And I want to point out this premise, and often that's hard to get, right? This idea of a strategic partner investing can be very powerful because it shows that those who are experts in the field are buying into your product. It shows the reviewers that you have the smart money in that space committing, and that is a testament just in and of itself, backed up by dollars. You can, for external CROs that are contractors, so contract research organizations, you charge F&A on top of those. So sometimes a very small company with 1 or 2 or 3 senior members on the team, the question is, well, how do I pay for $1 million worth of total cost internally on a $2 million SBIR? And there are ways to do that. One of them is the requirement that you charge F&A or overhead cost on top of external contract work. We'll go into a little more detail on that versus a subaward where you do not charge F&A, but that's one area where you can consume dollars, and that's overhead dollars that are spent within the company. This is one that I think everyone generally, I've seen this kind of is aware, people are aware of, that your 7% profit can be used for intellectual property. There's a bunch of unallowable costs that you want to be aware of and steer clear of. That hyperlink there will get you there, and there's another slide later that points out a couple additional ones as well. Bottom line could be the most important. I mean, they're all important, but this is something that is not as widely known, this concept of something called technical assistance costs. So this is a very interesting bucket for a line item in the budget, excuse me, that caps out at $6,500 for a phase 1 and $50,000 for a phase 2. There is the utility of applying that to business development costs, which is otherwise known as kind of sales or corporate development, IP, and other things that are typically not classed inside direct allowable costs. Importantly, these amounts don't count against the statutory limit. So that's a very nice feature. And you also charge overhead on top of those. Highly recommended to include those amounts. So there was one question in the chat that we'll get to at the end. So I just wanted to make a placeholder there. We saw that question, it'll come forward. Okay, I'm going to walk us through an example of a budget. So this is an actual client that has been blinded and brought forward for this example. So what I'm going to do is walk through this at a fairly high level and go into a couple of pearls of wisdom about how the budgets are created and some gremlins that you just want to watch out for as you walk through this process. If you're working with Grant Engine, we will have a conversation with you and draft up this budget, so you don't need to worry about it. But I think having this knowledge, whether you're using Grant Engine or not, is very valuable. So first, just to level set what we're looking at a high level, and then we'll dive into some individual rows here relatively quickly. So this workbook is the compilation of all of the entities, all the parties and people that will be working on the grant. So you can see this is a fast track grant, which you know is a phase 1 and a phase 2 together, undertaken in sequence. First the phase 1, then the phase 2. So this is a 3-year project. Phase 1 is 1 year. Phase 2 is 2 years, which is year 2 and 3 of the project. And we have a partner. We picked on Kansas University Medical Center that we'll come back to in a minute. So this is the subaward to the partner. So I'm gonna go into a bit of detail here on the phase 1 portion of the grant, which is year 1, and this can serve as an example of each of the subsequent years. So what are we looking at within each tab of the company's budget? And just to make clear, these two, KUMC year 1 and year 2 and 3, feed into the company's budget. So in this company budget, we've got a couple of sections. First section, direct cost of personnel. Okay. Next section, other direct costs. The next section is indirect cost. And then we have fee, a profit, and then a total. Okay, so those are the big picture sections that you're looking at. To walk through a little bit of detail here on each of those sections, the way we build and the way you often would build is to input the yellow highlighted cells. So you would put in the monthly salary. Oh, look at that. We hit the NIH cap with their annual salary divided by 12. That's their monthly rate. We're going to have a 12-month phase 1. They're going to have 13% level of effort. The rest of this spreadsheet that we can send to you if you're working with us, or you can get from, the KickStart team or others, will calculate out all of these net costs given these inputs at a 28.5% fringe rate, which is the max allowed. So that is how you would comprise the effort, and obviously you do a workup about how much time is going to be taken. You've got the hours per year to accomplish the aims. So that is how that all comes down to the total direct cost with fringe. Fringe, of course, is things like payroll taxes, healthcare, etc. Now we go to other direct. So these are things like consultants, external CMOs for contract manufacturing, CROs, and then, yep, you betcha, we got some technical assistance costs in there, and travel, among other things. So we don't have any dollars in there for equipment. That's red for a reason that'll become known in a moment. And note that this row, QA consultant, says 50K over here. That's the total cost of the project, and we're going to put into phase 1 25K of that. So that's just an easy way to navigate what you're looking at and keep your head squared away straight. So these other costs are line itemed. Other things that could be in there are things like supplies or materials. Then we go to the indirect section. So you can see here we've line itemed just a way to catalog these activities. And this can get a little complicated, so we'll obviously walk you through it when you're doing it live. But we want to catalog the direct cost for your consortium, and then also the indirect cost for the consortium. I'll walk through those as it relates to the phase 2 here just in a second. But there's something called modified base direct, where you essentially take all of your direct cost and you subtract equipment and take only the first 25K of any consortium direct costs, and you calculate that as a basis or a pool of costs, if you will, upon which you apply to that pool of costs your indirect rate here, 40%. So that's an important independent calculator. If you've seen budgets from UNC, you'll always see that modified base direct calc to remove equipment costs. This is a simple formula which multiplies your indirect rate of 40% against that that pool that's appropriate to apply. That gives you your indirect costs. So that's nice. You then add those up, where you add up the direct cost, the indirect cost, and the, so there's direct, and then direct from the consortium, which is 0 today. You add indirect from the company, indirect from the consortium, which is 0 today. That gives you your total direct and indirect, right, in that line item. And then that subtotal you apply 7% to. 7% is a profit that you apply, and then this total adds up your subtotal right here and your fee to equal that subtotal. So that's a budget. Like I said, we'll walk through some Q&A, but that's the workup of a budget. One other pro tip here is that you need to keep, for an SBIR, you need to keep the total expense that goes outside the company for external parties. So to not more than 49%. So another way to say that is that the amount of money that's spent direct inside the small business concern, which that's your company, has to be 50% or greater. Okay, so we have this little fancy calculator that calculates how much is external in each of the years, and you can see here that we are below the 50%, which means that the balance is spent inside the small business of much more than 50%. Another little nuance is that for the phase 2 portion of the grant, this is measured across both years together, right? So this really probably wants to show year 2 and year 3 together. So theoretically, you probably would never do this, but theoretically you could spend the entire amount internally in the first part of the phase 2 and the entire amount in year 3 of the grant externally. So you wouldn't probably practically do that, but it's measured across both years. So that is that's the workup of each budget. And then I just want to point out how we integrate consortium budgets into your budget roll-up for your company. So you can see here we're in year 2 of the grant, which is the start of the phase 2. So it's phase 2, year 1, or year 2 of the total grant, to be really clear. KUMC in this example is only in the phase 2. So to make this clear, we call this phase 2, year 1. And you can see their budget workup. Look at that. It has direct budget and it has indirect costs, right there. These push to these respective line items there. You see 127,355. That maps to the subtotal that you see there on the direct budget for KUMC for the same time frame. Year 2 of the total project is phase 2, year 1. That 127,355 shows up there as a direct cost for consortium 1. We also add indirect here. You're going to guess correctly that line, that where my cursor is right now, that 67,498 comes from that consortium indirect cost total and pushes to your roll-up spreadsheet for your project here on this row where the cursor is now. This obviously gets added in, as we saw before. You see direct, direct, indirect, indirect. So that's how the subaward portion integrates into your total roll-up project, and then for the subaward to KUMC in this case, you can see the individual years and totals therein. So that's the lay of the land as it relates to a budget. Year 3 is just more of the same, just that last year of the project. So that is a budget example. I want to just check in with
Yeah,
Monica and Suzanne.
question for you guys, because as you have the budget over there, the case of many of our startup companies is, again, most of them are applying for a phase one, and they're trying to figure out what would be, the right level that they could outsource to a CRO. What can they do in their labs as researchers, and what can they do via the startup company for work, and I know it varies a little bit by NIH compared to other grants. So the percentage that some of these agencies consider, can you maybe talk a little bit more about that? What percentage of that CRO work can they consider within that the amount of work that they had to do in their startup companies?
Yes, Mira, good question. We're going to jump the shark here to this slide. And I don't know, Mira and Judy, how you want to do this, but this was a question that was posed pre-webinar that we can answer now or later. How would you like to proceed?
I think we should answer now.
Okay, great. So, stop me if this is not your question, but I think you're asking how much can go outside the small business in any given grant. Is that correct?
Yes.
Yeah, great. Okay, so here's the answer, and these slides will be made available to you so you can use these as reference. So I'm going to walk through this, hopefully not too slowly, but just so it's clear. So there, of course, there are SBIRs and there are STTRs. The very simple answer is that for SBIRs, 1/3 of the cost, a maximum 1/3 of the cost can go outside, okay, which means 67%, if you just think about it on the inverse, over 2/3 of the work must be completed by the small business. That means that the budget, if the total budget is $100,000, $67,000 of that budget has to be completed by the small business, right? So it's dollars, okay? For a phase 2 SBIR, that limit increases. You can go up to half of the work. At least half of the budget must be spent by the small business. What is not included inside the small business costs? Consultants, external contractors, so CROs, contract manufacturers, medicinal chemistry, et cetera, and subawards to UNC, for example, and other third-party costs cannot exceed those limits. Okay, STTR, which I think is going to be a fair amount of the situations, these are all based on dollars. So when it says of the work must be completed, that refers to the percentage of the total budget in dollars. So at least 40% of the budget must be spent by the small business, and at least 30% of the budget must be completed by UNC in this case. And so you can have 60% spent at UNC, you can have 60% spent at UNC and a CRO. You can have 60% of an you'd have to have at least 30% though spent at UNC. Okay. If you hit these minimums, that leaves you with 30%, kind of that middle layer, if you think about it like that, that can go to to elsewhere. You can go back to your company, you can go back to the UNC or a third party.
And within the 40%, speaking about the STTR, that has to be completed by the small business. Within that 40%, is there any difference between the agencies as what they consider to be work from the startup? Like my understanding was that some agencies like NIH have a more flexible understanding of what that might be, and that they allow some CRO work to be, counted towards that 40%. Is that Is that sometimes the case, or is that never the case?
Yes, that can happen. But the best thing to do there is to speak with your PO to see, to determine that it's acceptable for you to use CRO costs or other costs as internal. But there is potential for that to be approved.
Great, thanks.
Yeah. Okay. Mira, does that answer your question?
Yes, thank you.
Okay, great. Okay, so we did a budget example. I think it's Judy's turn to take the floor. I'm going to stop the share so you can pick it up.
Thank you, Sam. I'm just going to set up my screen. And I think this is a really nice segue actually into an example UNC budget that I have prepared and we'll go through as we talk about, just want to make sure everyone can see my screen.
Yes.
Yes.
Great. So as Sam and Grant Engine have outlined, there are very specific considerations that NIH will make when it comes to their non-dilutive funding. And when preparing a budget, it's really important to consider with both your program officer, the actual division of NIH that you are applying to for the grants, what the budget constraints look like. But in addition to that, once the award has been granted to a startup, UNC-Chapel Hill has very specific considerations for processing these awards internally. And the reason that we've prepared this presentation is because typically once an award has been granted to a company, the next steps for communication with UNC are unclear. So we will both describe what happens with the subaward for a company with UNC, as well as how to respond to renting lab space, for example, for your startup and how that can be conducted at UNC. We will begin the presentation with just an example budget of a typical UNC startup that has received a phase 1 grant and how that's broken down into what I categorize in 3 different components, from the subaward to the startup research to external finance that's used for contracts, consultants, etc. So to begin, the subaward for a UNC startup typically goes to the University of North Carolina, Chapel Hill. And this is because it's usually the faculty founders laboratory that will be conducting the research within the subaward. So for a subaward budget, in this example, it's 30% of an overall $300K budget that has been granted to the university. The research will be conducted by UNC employees, again, within usually the faculty founders lab. And this subaward needs to be processed through the Office of Sponsored Research, which I will get into details within the next slide. But this is important to be considered because communication with OSR is not done through NIH, but through the startup itself. So just something to keep in mind, once the company has received a notice of award or a just-in-time, that next steps for communication will need to be with UNC's Office of Sponsored Research. So of the remaining 300K, if 90K is awarded to a subaward, that leaves 210K for the startup itself to be distributed between either startup research or external contracts. And Sam went through a couple of examples of these. This includes things like working with CROs, service providers, consultants. The point is, this is money that the UNC startup has to be spent externally. And this is external to their research, which would be conducted by employees hired by the startup and also requires the startup to rent laboratory space. This is important because one of the most critical steps when it comes to figuring out, where do I as a company set up my laboratory, it's not like I can do this within my own academic space, is to think about where within the state, and specifically even, do I want to try to do this research at UNC, and is that even possible? So we will go over an example, including the KickStart Accelerator, which will help you figure out if you want to make the decision to work on campus and how you will be able to do that as a private company. So in terms of processing a subcontract or a subaward at UNC, as I mentioned earlier, the company has to notify UNC's Office of Sponsored Research. And this is because, unlike with academic grants, NIH does not notify UNC once an award has been given to a company. This is because the communication is directly between NIH and the startup company representative, whoever that may be. And so what happens next is that that company representative needs to approach the Office of Sponsored Research with two documents. The first is a copy of the full STTR application. And this is important because it breaks down not only the budget for the entire award, but also what the scope of research is for the subaward and for the company. And that information is necessary for OSR to move forward with conflict of interest when it comes time to approve the subaward and permit the laboratory on campus to begin executing that research that's described within. The second very important document that needs to be given to OSR is a copy of the just-in-time or the notice of award itself from NIH. And the reason that we're bringing up the just-in-time is because these documents are becoming more common at the time of notification rather than an NOA. And so in order to expedite the processing of a subaward, even if you don't have your NOA in hand, but you have received a just-in-time, we recommend notifying the Office of Sponsored Research that you have this document so that they are aware that there, in all likelihood, is a pretty good chance that you will be granted the award at a later date. So as soon as you can get these two documents to OSR, you'll be in a better position to execute your subaward as soon as possible. It is important that these documents be provided not by the faculty founder, but a company representative to the university. And again, this is because of conflict of interest rules that are important when it comes to distinguishing between what is company-specific obligations versus what is an academic founder's obligations when it comes to working with the company. And so the founder is responsible in most cases for conducting the research within the subaward and overseeing that, but all communication with UNC must be done by the company representative and not the faculty founder. So what we can do here at KickStart is provide the company representative with 3 pieces of information that they need when it comes time to communicate with OSR. The first is the proposal number for the application, which is internal. The second is the email address and contact information for the proposal specialist for this award at OSR. And the third is the primary award contact. And this is usually the business person in your subaward department who will need the information to move forward with processing the award. And so the sooner you can update KickStart, once you receive that just-in-time or notice of award, the sooner we can get you this information so that you can begin the process of processing your subcontract. So now that we've reviewed how you can get your subcontract up and running, the next question is, how can I, as an academic founder, start leasing company laboratory space to perform startup experiments? And can I even do these experiments at UNC? And in this particular case, because we have wet lab space on campus that can be used by UNC companies, it is possible to lease space at the KickStart Accelerator, which again is laboratory space that is provided only for UNC startups that need company-specific space to do company-specific research. And as I mentioned in the earlier slide, this is research that must be conducted by the company itself. This is, depending on if you're doing an SBIR or an STTR, it can be a minimum of 40% of your funding. So in this case, when a company out of UNC wants to rent laboratory space, the accelerator is a great option. There is over 7,500 square feet of space that's available within the Genome Sciences building. And we have both bench space and private labs available for UNC startups to use. Now, Being able to use this space, while it is a great opportunity for UNC startups, does require a facilities use agreement with the university. And so in order to process this agreement and in order to help provide some guidance and administrative support, we really recommend that startups reach out to the KickStart team, because we can help you prepare your application, navigate working with the different offices on campus to get this agreement signed, and begin your company's specific research as soon as possible. If you have any questions about anything that we've just discussed when it comes to the UNC specific processes for processing your subaward, or when it comes to get lab space on campus for your company, please feel free to email me or anyone else on the KickStart team with your questions. We're here to help you with any and all queries that you have about your STTR or SBIR subawards. So that's it for me. Maria, do you have any questions or suggestions before we move on?
I want to make sure we answer some questions from the audience. I know there was one attendee that had a question about how, what is the leniency of deviation on the budget, what actually, I guess, what you wrote into the award versus, what you had to do later, So I want to hear from the rest of Sam and the rest of the grant engine team of what they can recommend also for our attendee here as well.
So I can answer that question. So you are allowed to rebudget up to 25% of the awarded amount without pre-approval from the NIH. So if you have a $100,000 budget, you could rebudget $25,000 without requesting any approval from them. And then if you exceed that amount or plan to exceed that amount, of course, you'd have to send a prior approval request to the grants management specialist and the PO.
Another question kind of related about, now particularly with COVID, things have changed a lot for startup companies, and maybe they just got notification of an award. How flexible are they with start dates? What do you need to do if you need to, you just mentioned about notifying if you want to change the budget. Would that also apply for the change of the start date for the award or starting those experiments?
So you can start your if you are certain you're going to be funded, you can start your project up to 90 days prior to the anticipated start date. And the NIH will reimburse you for any costs incurred during that period. Now, delaying the start date would require approval, but in most cases, you wouldn't want to delay the start date, especially if you're getting close to the end of the government fiscal year, which is September 30th. You would just want to accept the start date they provide and then take the automatic one cost extension, or however many months up to 1 year that you would need at the end of the project period to extend that year or the budget period for your company.
I have a question from the audience as well. Do you need to have a license by UNC to receive an STTR subaward to the PI?
Do you want me to take a crack at that, Monica?
Yes, sure.
Yeah. So my experience after taking 3 companies out of UNC is that it depends. I would say that you absolutely, at a minimum, you absolutely want to have a license inked, like signed, sealed, and delivered. That is vastly preferred. If you have my experience has been is if you have a term sheet that's by and large negotiated and you have a letter of support from Jackie or a senior member of the technology transfer team at Carolina, then that can also work. Emphasis on can. I would absolutely encourage everyone to get the license done before you submit the grant, and if not then absolutely before you contemplate receiving a notice of award. I've gotten notice of awards without it, and it's not preferred. It's respectful to the phenomenal investment that Carolina has made into the technology to do that, and that certainly wants to be the best practice, but it just depends. It can happen, but I would just say you generally don't want it to happen for reasons of prudence.
And another question from the audience, a little bit different subject. You know, many of our startups are considering applying for phase 1, but you know, more and more like this mechanism to apply for like a direct to phase 2 or a phase 1-2 combo. You know, how do you know, what do you think is the most favorably funded? You know, what do you recommend to the audience to consider when they're going for one or the other? Yeah.
Yeah, it's a very important question, actually, and this is strategically useful to think about. So the concept of what the SBIR program is really all about is to get products on market, right? And so if you think about this concept of a direct to phase 2, where you have not done a phase 1 award, but you have done essentially the equivalent of a phase 1 work. So if you think about a total budget, and I'll pull up a screen here to show the dollar amounts. Phase 1 is $256,000 at the statutory limit. That's total cost. Direct is about $165 or $170. What could you have done for $170,000, call it, approximately, in terms of the scope? If you've already done that level of work, and the product data supports the differentiation and that story therein, then going after a direct to phase 2 can be a smart money decision. I think everyone's probably familiar that the phase 2 is essentially 4 times the work, right? You got to write double the research strategy plus a whole commercialization plan, but it's 6 times the money. And you know, 256K is not anything to sneeze at, but it's really not enough money to do much of anything. You know, you're going to get a proof of concept work out of it that's useful, et cetera. $1.7 million with budget waivers, that goes up to $2.5 million, $2.8 million in some cases. You know, that's money that you can actually make progress on. So the premise of going after lots of phase 1s, you know, is good, no question. The premise of going after phase 2s or fast tracks, that's where the smart money is. And by and large, if the data supports it, you want to go there. It does demand an increased level of rigor and focus about what is your product going to be. For any real med tech product, you need to have a product that is ready for commercial sale coming out of that phase 2 activity. So you have to have clear line of sight going into that of what you know that product is all about. So long story, it's worth it if you, as my friend Paul Dayton says, you know, the juice is worth the squeeze. It's just a smart thing to go do if you can.
And by data, if it's a therapeutic or perhaps a device, you need to have animal data to support that, yeah?
Yeah, so there are no absolute rules here, but that point you just made, is generally the case. Yes, you want to have animal data, and the animal data that you have really wants to show, ideally it would show efficacy of your product against a control, or no product, and against the current standard of care, and it would also show safety, right? So when you're doing a therapeutic, there's lots of metrics of importance, but the FDA is only going to worry about 2 things, and so if you can show both safety and efficacy, that's better than just showing safety or just showing efficacy. And it just depends on what the product is. There are some therapeutics where you're not going to really, like Alzheimer's, it's just tough to show, or some other CNS, it's tough to show animal data that's in a reliable model. So yes, you'd want to have it, but it really depends is the real answer. But yeah, I think that's, you want to have animal data for therapeutics and many med tech products as well. But the real answer is it depends.
And then I just wanted to add to kind of like what Judy was mentioning earlier, you know, so as you work with Grant Engine or a different service provider or yourself on writing these budgets, I really want to encourage everybody to kind of think, like, what is the role of the startup company and what is the role of the university and the contract research organizations you might work or not work with. Some of the problems that we tend to see that cross our table, once they get the award, we're very excited to work with these companies. And then they reach the point where Judy was describing, it's like, let's implement this at the university. And you end up finding out that there was a lot of overlap with the faculty member was promising to do at the startup that actually is falling during the research side. And that generates all sorts of conflict of interest. So again, having a clear separation very well from the very beginning avoids a lot of headaches later, and also kind of makes it more professional when you're submitting your budgets and an application as well. Just kind of very clear definition. What is it that you're going to be doing as a startup company? Very different people. So typically if you're putting yourself doing stuff as a faculty founder in both areas, that's when there starts to be issues as well. But again, we're all here to support you. I don't know if anybody has any final comments or questions before we close the webinar today.
There were some questions posed prior. We're at 2 p.m. right now, so I don't know how you want to proceed with these or not.
Yeah, we can go ahead with some of those if you want, Sam. Please go ahead. Yeah.
Okay.
More minutes on that. Yeah.
Okay. All right. Well, I'll move through these pretty quickly. So, yeah, what's the max budget? They're listed here, but go after the budget waivers. That's where real money is. We talked about external costs outside the small business concern. Thinking about external costs for either a subaward or contracted research, there's a big difference. And I think a simple way to think about this is that contractors are generally for-profit service providers, generally speaking. They can also be a core lab at a university, but you'd think about them as a vendor or a CRO. And subaward entities generally have a negotiated rate with the NIH. And there's much more detail that the team at Grant Engine has put together about characteristics of each. So those are relevant, but one rule of thumb that I find simple is that subawards have a negotiated rate. You don't, for their fixed and administrative, their overhead, and you don't tack on your own overhead on top of it. That's just that you don't get to add your own overhead on top of that subawards entities overhead. Contractors, as mentioned before, you do. How much documentation do you need? That external contractor, you just need a quote. Throw it in the budget justification section. For a subaward, this would be a university, generally speaking, UNC, Duke, KUMC, et cetera. You need the letter of intent signed by an authorized official, which includes these key pieces of information, the budget, the justification, and a paragraph generally that documents the statement of work. One thing I want to just mention, I think everyone knows this, but it should go mentioned all the time. UNC has made the big investment to waive overhead costs for phase 1 SBIR STTR projects. So that's been in place for a number of years and an incredible benefit to companies. Percent effort, there's no minimum for SBIR program, but generally 10% is a good rule of thumb for SBIR. It's mandatory for STTR. And here, we talked a little bit about the approach to calculate up percent effort. Go back and read these slides later. It's really valuable. we're going over time here, so I want to do this justice. This is going to take a couple minutes, and it's important. So how do you account for indirect costs? The short answer is that the NIH, at least, allows you to include an overhead rate of 40% of the direct cost. That's how you calculate overhead, without negotiating that rate. These equipment costs and subawards outside the 25K are excluded. If you want to go beyond the 40%, then you have to negotiate that rate with the NIH at time of award, prior to award, but as you're going through JIT. You don't get to do a higher total awarded amount. It just eats into your direct costs. But 40% is just straight up. You don't need documentation. That's allowed without negotiation. This important middle section underlines the point we talked about earlier, which is it's super easy to not realize how much it costs to run a business. We've had folks come to us and say, hey, can we just make F&A 0? And we've told them that's just not a good idea. And most folks listen. Some folks don't, and then they come back to us and say, what the heck? We're not going to play Monday morning quarterback, but it's just a hard lesson that companies before you have learned, which is you need the F&A. So don't drop it down. And these are some of the costs that you have here.
With the success fees for grant services, let's say if a company decides to work with Grant Engine or somebody else, would that come from F&A or from the technical support budget?
Yeah, Lenika, do you want to answer that, or do you want me to take it? I can.
So I would recommend that come from the fee line item of the budget, the profit.
Yep.
But grant writing can come from F&A, but not, I guess when you get that F&A from an award, you would be using it for future grant writing, not necessarily the grant that was awarded. Does that answer your question?
Yes, thank you.
Mm-hmm.
Yeah, great. And our fees are never the maximum profit that you'd receive. So there's still money left over for IP if you need it, and you can use technical assistance cost for intellectual property as well. Okay, what do I have to report out because I got funds? This is really relevant, and necessary to pay close attention to, whether you use an outside firm or not. You have to use an accounting system. You have to track details of all the income expenses. You need documentation, invoices, timesheets. A time management system is mandatory. There are many different time tracking systems out there, but one of them, you need a system. You need to have a reliable way of tracking time. And then reporting out quarterly financial results, and then within 4 months of the award finishing, you need a final financial report to document all the direct and indirect. So that's the questions we got prior, which brings us to, I think, at slightly over, but not too bad, the questions that were posed.
Thank you very much, Sam, Lenika, and Susanna. I think this is very helpful for many of our startups. And again, and Judy too, we will be again sharing this webinar as well with the rest of our startup companies and those who registered for the seminar, as well as the attendees today. And I'm sure many might have some questions or comments later as well. Yeah.
Great. Thanks, everybody.
Thank you so much.
Thank you.
Okay. Take care.
Have a good
Bye.
day.
Bye.